Oil prices moving lower on optimism around Iran and Oman reaching a deal to secure safe passage through the Strait of Hormuz. For more, let's bring in Jeff Currie, Real Macro CEO. Jeff, it's good to see you. We'll just do some remedial work here. There's been an idea in the marketplace that the reason we're not well over 100 is because we're still pretty well supplied in a lot of places, I guess here at least. And that China cut down on the amount of oil it was stockpiling, and that eased, I guess, the demand side of things. Is that still true? And is it true? Was it ever true?
By the way, why do you care about oil? Nobody consumes oil. Oil is noise. Product are the signals. You know, you look at diesel. It's what on your screen, somewhere what $4.14 a gallon wholesale and $5.47 a gallon at the retail. You put the gasoline and the diesel together, you're sitting around $160 a barrel, $174 a barrel on diesel. That's what matters. That's what matters is affordability. That's what matters to CPI. So, you know, I'm a little shocked of this obsession with crude oil, yet nobody has any crude oil exposure, but somebody either owns an oil company, owns a refinery, which is a small number. The vast majority of everybody else that's listening to you has gasoline and diesel exposure. And there, diesel was 174. I think I know the crack spread is around 94. The all-time high was 102 last week. That's where the signal is. Crude is just, you know, another week, another deal, more headline noise. It's not telling you anything. So, you know, when I look at the situation globally, the number of, and the Straits of Hormuz is just one in a long list of choke points that are being squeezed right now. So, you know, I'm a little confused to why the market is so obsessed with where crude oil prices are when nobody actually consumes it.
Why did these derivative products go up so much more than crude, I guess is the question, because one's built no refineries, and where are the other choke points?
It's a combination, you know, if we let's go through the list of choke points. And by the way, I'm bullish the entire commodity complex right now. I came out last week, doubled down on agriculture, gold, silver. So let's go over the choke points other than the Straits of Hormuz, which shut down refineries behind there, and that's the problem. One thing that happened is you had crude oil that was stuck behind the straits in June and July. That came all flushing out. So there is some real truth to that point you're talking about flushing out the crude, but you can't get out the products. Why? Because you aren't going to take a chance of taking a product laden tanker through there and getting hit with a missile because, you know, gasoline is far more flammable than crude oil. So that's one point we have. It. The other one is China cut its exports of products. Everybody goes, oh, China is the reason why energy prices are lower. No, they're the reason why energy prices are higher. They are a net exporter of product, usually, and they are not exporting product right now. So they contribute to having higher energy prices. Let's go through the refineries in Russia. You know, at one point, you had more than 50% of the refineries taking out. You know, we'll find out what the numbers are, but there's a limit on how much crude they can export, which you're bumping up against that, and now you've actually lost the products. It's 10% of global diesel supplies, and at the same time, they're importing jet fuel from Japan, diesel and gasoline from India, and this is supposedly the world's largest exporter. Also, the grain corridor through the Black Sea, it's been taken out by the Ukrainians. So they take out the refineries, they've taken out the grains, which is why you have corn sitting at $5.47 and why I, double down on being long the grains right now. Other choke points, Red Sea, Rhine River, Panama Canal. These are weather-driven events, whether if it's war or weather, you're now really creating significant bottlenecks. And so that's why, you can say, oh, yeah, crude is off. It's immaterial in terms of thinking about what's happening at affordability level as well as at the CPI level.
So if Kevin Warsh is watching right now, I think he watches occasionally. If he's watching right now, wouldn't a couple of rate hikes sort of be built into at least the way you view the world right now, Jeff?
Well, I mean, part of the problem about it, as we saw with Bessent last week, they can't afford the higher rates. Because of the, take out the interest payments is somewhere around 1.1 trillion. And if they had to roll all that debt forward, you could be sitting there as high as 1.5 trillion. To reprice, you take all the debt right now, it's priced around 3.2%. You roll it all forward, you're at like 4.5%.
Your inflation outlook sounds not great.
No, that's why, by the way, gold is in agreement with me. We've come off the lows of 4,000. We're back to 4,700. We're going to retest the highs of 5,500. It could happen, before the end of September. And I think that, the precious metals markets, Bitcoin, they're all telling you this is pretty serious right now.